Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of December the 16th, 2024. Now, as one of the final outlooks of the year, we're going into probably a higher volume period next week and then all liquidity is going to dry up. So if you're going to have a volatile week, it will likely be next week. Now, the dollar is recovering. You can see we've come down just below our T-cross long, but the monthly opening remains positive for the dollar. Again, when we use proper anchor points in our trading, then we know if something is bullish or bearish. Now, there is significant resistance at 107 where the dollar has not been able to break through. We'll continue to monitor this area, but it's a very mixed bag of signals. We can see that our MA diff cross is getting ready potentially to cross back down to the downside. We do have the Fed next week, and I don't think there is anything on the table that would see a hawkish Fed suggesting he's going to hold or he's going to change his rate cut cycle in 2025 because the data points just aren't there. We had a slightly hotter PPI number this week, but that doesn't change the payroll numbers. The other CPI is basically flatlining. So I believe the Fed will move towards more rate cuts in 2025, but that's left to be seen. So for now, I believe that our resistance high at 108 here will contain any further rally in the US dollar in 2024. And 2025 is very, very likely to see a more negative dollar, but there's a lot of change coming, new administration coming in. So we'll see where things go. But again, this is pretty much the final week of trading as we move into Christmas and New Year's, and that liquidity will dry up. Now, gold has made a nice push this week. We did pull back. We pulled back after that PPI number, which I believe was on Thursday, and that did cause a little bit of a bump back to the downside in gold. So a little bit of position adjusting ahead of that number. But once again, the question is, can gold continue to rally? So we've pulled back on Thursday and Friday, but we're basically holding above that monthly opening price. That's coming in around about the 2650 area approximately here. Let me just back that up a little bit so we can see that number. Yes, the monthly opening price coming in at 2650.59. We're closing again just a hair below that, but I believe that gold is the better play here going into month end or year end than the US dollar, because historically that's what I've seen is a stronger gold in the month of December and a weaker dollar. So again, the main indicators here are warning that there could be a little bit more downside on gold. If it's going to rebound, it's likely going to be Tuesday through Friday of next week. But as you can see, we've got an MA diff cross to the downside, but we've got to break through a clean break of 2650 and stay below that area before we consider shorts. Now, with the S&P 500, we finished slightly positive on the week, same as the SPYs here, guys. Again, very important that we're not using random points of reference as to what performance is. The performance is pretty straightforward. We start at the beginning of the month, we end at the beginning of the month. We start at the beginning of the year, we end at the beginning of the year. We also then break it down into the 4 quarters per year. So again, the S&P firmly bullish on the year, firmly bullish on the quarter, 57.57, and we're holding right along the monthly opening price at 60.40, closing at about 60.51 in the week. So going into year end here, guys, I believe that there's a stronger bias for upside on equities and gold versus the dollar and maybe some of the other markets. So for now, our T-cross long is at 60.19. We're looking to hold above that area. We can notice here that the predicted RSI is running flat. We have got no momentum to the downside, not as of yet anyway. So again, if I'm going to sell the equity markets, I've got to break down below the T-cross long, below the monthly opening price, and I need to get that RSI showing me I have momentum building to the downside, which currently it is not supporting that. When we look at the European equities, as we discussed last week, that if either the S&P 500 is lagging slightly behind the DAX or the DAX is likely going to pause. So last week, basically just a down week. But not down huge, guys. We're only down 0.31%. So again, a corrective move back to our T-cross long, 19,961, and an additional level of support here that I would like to see hold next week is 20,301. Now, again, if it breaks through that, then we follow the other number. Again, we would have to break down below that long predicted to get to the T-cross long. But when we're looking at both of these equity markets, we want to make sure that we're cross-referencing it to the VIX. Now, the VIX is still above its yearly opening price, but as you can see, this is very concerning to me that we're banging up against the Vantage Point T-cross long for basically 6 to 7 trading days consecutively. That could be deemed bullish while we're above 1501. So I would still, even though I support equity long in the equity markets, I would be a little bit cautious next week with that Fed because we're going to see that volatility, and it could be just again price adjustments going into the Fed, and then Thursday and Friday we start to rally, and then a little bit of a Santa Claus rally into Christmas and January 1st. But be very, very cautious buying the indices if we break above that T-cross long at 1650. Now, when we look at one of the top markets this year, yet again, Bitcoin still holding in there, doing quite well. Our T-cross long coming in at 97,595. In my respectful opinion only, if we close above 100,000 this year in 2024, which I believe we can, that would set the tone for a very bullish 2025 on Bitcoin, particularly in that first quarter. So we'll monitor. Right now, the indicators are still showing we have some momentum here, but again, we need to stay above that psychological barrier of 100,000. We broke above it multiple times, but we've also hit the monthly projection targets here at 106. So again, we continue to monitor Bitcoin, but we could see some profit taking into year end. But if we do, I would use that respectfully as a buying opportunity because 2025 is likely to be very similar to 2024. Then in 2026, we look for a 30, 40, maybe even 50% corrective move like I've seen in a 3-year cycle going back to 2011, 2014. Every time Bitcoin has a down year of 50% or more, it has 3 consecutive years of a rally. Last year we were up 155%. We're easily going to be up that this year. So one more strong year, then a corrective year. So we'll monitor it again as best we can. There's a lot of incoming data, a lot of fundamentals that could change things, both positively and negatively. Now, the final commodity we would look at would be light sweet crude oil. Little bit of a rebound this past week, but I believe you have a decent selling opportunity at the current yearly opening price, 71.78. So again, you can see that there's very little resistance up here other than that blue line, the calendar yearly opening. Once again, this is why we don't move those anchor points to random periods. Random 60 days, random 90 days. I discuss this every single week to drill this point home, guys, that you can't pick and choose where your performance is coming from. We need it from the start of the year, the start of the month, the start of the quarter, and even the start of the week can be a very useful price action based tool and then bring in the predictive indicators. So I believe that this is a corrective move higher, and anything above 71 is likely a sell. So be very, very cautious with oil next week if you're long. Now, when we look at some of our main Forex pairs, basically, guys, your G7 pairs are all about either selling or buying US dollars. So the euro, ECB has cut rates. This is a very bearish setup below the yearly, the quarterly, and the monthly. Our T-cross long. So again, it's all about the dollar index here, guys. If the dollar index continues to fail near 107, the euro will likely rebound. And the question remains is what is the Fed going to say this coming week? Is he going to say that it's a one-off cut and then it's going to be incoming data? They're going to monitor the data. Well, that could be dollar bullish. That could be a trigger to send the euro lower. However, if the Fed says, look, things are softening here and we're staying on this rate cut path in 2025, then we could see the euro rally. So again, it's all about the Fed this coming week, but I will point out we have an MA diff cross that's forming and very, very heavy support that I would argue between 104.06 and 104 and 103.34 with an indicator with the indicators from VP slightly bullish going into next week. Now, the US Swiss franc, I think, is a pretty decent sell up here. We've got a verified resistance high, 89, about 89.57. And again, as long as we're below that area, then you likely do have a short trade. It would be contrarian, but we can see that the predicted RSI is losing momentum. It's flattened out. The neural index strength is pointing down while the neural index is green. But the other thing that you'll notice with the predicted neural index strength is the further it moves away from the zero line, the more likely it is there's going to be a retracement that has absolutely nothing to do with conventional technical analysis. Fibonacci, waves, all of these things. We're looking for a retracement back to our T-cross long, 88.39. That's what I would keep an eye out for, but again, still dependent on the Fed. When we look at the pound dollar, again, as I discussed last week, this is an indisputable fact that the bulls and the bears are fighting it out right at the calendar yearly opening price. Now, if I remove the monthly opening and I removed the yearly opening price, then it would just automatically look bearish. But that may not be the case here, guys. So if you can get back up above the T-cross long, that area coming in at 127.21, and the yearly opening price at 127.32, then that would confirm to us the dollar is peaked for the year and maybe even the first part of 2025 with the Fed. But again, still dependent on that Fed. But the indicators, at least for now, are bearish, but be very cautious of a false break here. Now, the dollar yen has recovered. But once again, the interest rate differential is going to be the driving factor here. So in my respectful opinion only, I have no interest in buying this pair above 150, 155. So we've got a verified resistance high, two of them sitting here, one at 155.88, one at 56.75. If you're so inclined to attempt shorts, that's where it would be. Maybe slightly above that area. But I believe the interest rate differential between the Bank of Japan and the Fed will change. And when it changes, it will favor the yen. In most cases, the yen is a little stronger at this time of year with its correlation to gold. So watch for a potential short here. But for now, or an alternative strategy is simply put sell orders below 152.05. If we break down below the T-cross long, then that simply confirms the dollar is peaked and we should be looking for shorts. Now, with the US-Canadian pair, certainly very little love for the Canadian dollar these days. And this is a combination of Trudeau, the Bank of Canada, the economy, the jobs number. There's a lot of factors involved in this Canadian dollar weakness. So I believe Canada will have an election early in 2025. It's just a matter of time now with a non-confidence vote. So that's keeping the Canadian dollar very choppy, very volatile. But again, it's been a long time, I think since COVID. And then the last time I saw the Canadian dollar this high was when Trudeau's father was in power in Canada. So again, the apple doesn't fall far from the tree there. But again, we will see here, there is still the possibility the Canadian dollar can recover based around not the Canadian dollar strength, but US dollar weakness with the Fed. So the indicators right now remain bullish on this particular pair. And again, the fundamentals do support longs, but be careful going long at these levels. Some of the analysts are talking 160. That's possible. But I think it would be very short-lived as the Canadian economy ramps up in 2025 and 2026 once Trudeau is put out. So we'll see if that even happens. But if it does, it would be a positive for the Canadian dollar. So all we can do is monitor the political situation in Canada and the US. I'm Switzerland. I'm neutral on this. So I'm simply just pointing out what's going on where I'm domiciled. So again, we will see, but the indicators still looking for a short signal on this pair, and we don't have one. The Aussie and the Kiwi are falling into the same grouping as the CAD here, guys. These three currencies are very highly correlated, the Aussie, the Kiwi, and the CAD. So when we look at the Aussie, once again, we're really pushing lower here again. But from the indicator standpoint in VP, the contrarian indicators, the neural index strength, the MA diff cross looks like it's getting ready to cross back to the upside while the market moves down strongly. That's exactly the kind of divergence we look for. So again, watch and see if this develops, but I believe it will. If not in 2024, in the first and second quarter of 2025, that basically it's a fire sale buying the Aussie and the Kiwi at these levels. So doesn't mean it can't go lower here in the near term, but if that MA diff crosses back to the upside, I believe we have a long trade. And the Aussie would be the same thing. The Kiwi is again under more pressure here, but we already have an MA diff starting to form. Excuse me, I meant to say the Kiwi and the other pair. The Aussie here is showing a little bit more strength here. And for cross pair traders, this is one of my favorites. The Aussie Kiwi often determines which one I will buy between Aussie US and New Zealand US. So if Aussie New Zealand is bullish, then I would prefer to buy Aussie US versus New Zealand US, because that's how this works, guys. For traders to trade Aussie New Zealand longs, they have to buy Aussie US and sell New Zealand US to buy this cross pair. So that puts a lot of pressure potentially on those G7 pairs. So right now, well, it's very interesting what we're seeing here, that it's starting to recover here. We're above the quarterly opening, the yearly opening, the weekly opening, the monthly opening. So that basically favors the Aussie US over the New Zealand US. And I thought I would just take a moment to explain why the Aussie is slightly stronger than the Kiwi in most cases. So again, if this pair can move higher, then that should help pull the Aussie up with it. But once again here, guys, we're going to go into a very volatile week next week. We've got the Fed. This is pretty much the final week of full volume trading in the markets. Then when we come back on the 22nd, 23rd, all liquidity will dry up. So make sure you make all your position adjustments this coming week, not the following. So with that said, this is the VantagePoint AI Market Outlook for the week of December the 16th, 2020.